All right, we're just about getting ready to go live. Just take another second. Give me a second. We're a little bit early for a change, so I just want to make sure I've got the right overlays. Any second, we're going to go live, give people a chance to join us. Okay, here we go. Hello there, I'm Mitch Goldberg with Client First Strategy. You're watching my live stream, which I call Be the Boss of Your Money, because it's easy for your money to become the boss of you. But the idea is we want you to be the boss of your money. So welcome to my live stream. We've got a couple of things to talk about, but today's focus is squarely on personal finance and investing. But I want to focus on something that could make you a better investor. I want to focus on something that if you learn early enough in your accumulation years, um, it could make a significant difference in your life in 20, 30 years down the road. Um, and I want to share with you how, like, successful investors, how is it that they always seem to be able to get through tough markets in one piece? They always seem to be able to invest in tough markets. How do they do it? I have to tell you, it's really not complicated, but it has to do with the kind of investor you are. So the title of this live stream is There Are Two Kinds of Investors. There are results driven and process driven. Which one are you, and which one would be better for you? And if you learn these, if you learn what I'm talking about, you will learn this because I'm going to tell you all about it. It'll make a significant difference for you in your life. I'm very excited about it. So let's roll the intro. We're going to skip the usual market up, market down. Today was just a nice day, a little bit of a rebound from yesterday. It's kind of like we took back yesterday, and what we took back from yesterday, what we lost yesterday to today. S&P, NASDAQ hit records by a tiny bit, but it's just a continuation of what we saw, of what we've been seeing the last few weeks. So here's the intro. Stick around. The difference between result-oriented and process-oriented investors, and which one should you be? Hello, everyone out there. I see you, Maria Marizio. Thank you so much really appreciate that. I'm hoping to have Frank on as my guest over the near term, so that'll be a lot of fun. We've got a few other people out there. So listen, if you are watching this, obviously you're watching this because what else would you possibly want to do with your time, right? But hit me up in the comments with any questions you may have. I love answering your questions. To me, that is to me, answering your questions is the best part of this. It's the most fun. It's the best content. So definitely hit me up with your questions. If you're watching this in the live stream, welcome. If you're watching this in the replay, I'd like to welcome you as well and thank you for your time. If you have any questions while you're watching this in the replay, hit me up in the comments. I'll see them. I'll answer, and let's have a good time. So the story of the day is there are two kinds of investors: those who are results driven, those who are process driven. There is a difference, and it might seem kind of subtle. Well, every investor wants to make money. That's the goal, right? I mean, making money is the goal of every investor. So if you're making money, then you must be doing something right. You're meeting your goal. That's not really the point. I mean, that's such a general statement. It's like one of those yes statements. Like it's like somebody saying, "Don't you want to make money?" Yeah, of course. The answer has to be yes. You have to be an idiot to say no. But there's more to it because market cycles change, and if you could tell the difference of what kind of investor you are, and it might seem somewhat simplistic by saying, oh, there are two kinds of investors. We know there are many, many different kinds of investors, as there are many different kinds of people. But I like to use this broad categorization categories. Okay, categorization. I think I said it. Okay, I said it right. Yeah, I like to do this because it illustrates a point of personal finance. And even if you are experienced in investing and you are well into your accumulation years, your asset accumulation years, you could still maybe use a reminder because this is important. And sometimes, investors lose their way a little bit. We stray from the plan. So let's just take a quick look at this. Okay. A results driven investor is someone they're all about the returns. And before you say, oh, Mitch, we should all be about the returns, not quite, because if you're results driven, you're more about not the risk, not the potential downside. Results oriented investors are looking to make money now, and they want all of their investments to be working now at the same time. What's wrong with that? Well, it would be great, except that when you are using a tool called diversification, it's not so great. Diversification is a strategy that we use to mitigate risk so that your return is not just based on one single investment. It doesn't necessarily, diversification doesn't necessarily protect you. It won't protect your portfolio from going down in a generally down market. But the point is, some investments go up, some investments go down. And when you're results driven, you could tend to concentrate in a single asset class, or having, let's say becoming overly concentrated in just large cap tech stocks. Like if your portfolio has become like 70% FANG M stocks, that's Facebook, Amazon, Alphabet, Netflix, Google, and Microsoft, and that's like now 70% of your portfolio, I don't really think you're diversified. Diversification, by its very nature, involves having investments that do poorly while others do well. That's called non-correlation. While some investments go up, some go down. So that's non-correlation. Okay. Um, so that's one thing. I think results-oriented investors are typically relying on supercharged returns to meet their financial goals. I mean, obviously, when your investments go up more and faster, that does help you get closer to reaching your financial goals for the future because you have more money today. The more money you have today invested means the more money you should have tomorrow. It just kind of feeds on itself. And typically a results-oriented investor is very tied to momentum investing, and they often are known. Results-oriented investors want to chase the hot new shiny thing, the investments that are showing the strongest performance, or investments that are getting the most media attention. All right. And an example of that, I'm not knocking them, I'm just saying that these aren't for everybody. It's like, let's say Bitcoin and some of the smaller, airline stocks, for example. That doesn't mean there's anything wrong with them. But when you're results oriented, you're buying something because, hey, it's going up. I should buy it because I could make money on it. That's one way to look at investing. But it's and last thing, I think results oriented investors, if they're right just a few times, often become very overconfident very quickly. So these types of investments that results oriented investors are chasing, this is because we're in a bull market. Okay. So just want to check for any comments out there. Okay, so let me go on. But a process driven investor also wants to make money in the market. Process investor, okay, in my experience, I've been doing what I do now for over 30 years. It's coming up to 31 years. I know. I don't look it. So a process driven investor also wants to make money in the market. They want to make money on their investments. They're no different than anyone else, but they're doing it in a with a different thought pattern. They follow a process, whereas a process driven investor would focus on things that they could control, like dollar cost averaging, like reinvesting dividends and interest, because they're looking to invest also, but they're looking to, you know, work with what they have. They're looking to dollar cost average as opposed to saying, well, why don't we just throw $15,000 into that, $50,000 into that, $100,000 into that, and just see, they all sound good, see how they work. And that's their investment plan. That's not an investment plan. That is just, throwing spaghetti against the fridge to see what sticks. A process driven investor always considers how any new investment or adding more to an existing investment would affect their overall investment portfolio and their overall financial plan. Okay. A process driven investor doesn't switch investments just because something is hot going up a lot and they want to just run into that. I'm not saying a process driven investor can't take a shot on something here and there. That's not what I'm saying. But generally speaking, a process-driven investor will have an asset allocation model of stocks, bonds, and cash. And for example, they'll take their stocks and decide how much should be in small cap, mid cap, large cap, international, dividend producing type of dividend paying stocks, for example. And then they'll break it down and get more granular either through exchange traded funds, or they'll just have individual stocks, individual securities, and everything has a place within their portfolio, and they have a way of measuring the risk profile of their portfolio. And also, a process driven investor understands their own internal risk tolerance. They understand their risk tolerance, their goals, their time horizon, and that is what they base their investment decisions on, not just what's the hottest stock or the investment that's going up the most, or some investment with the most promise. So someone's going to say, well, I bought Zoom at $10 and it's like 400, which by the way, down from almost 600. I'm not knocking that. That could be part of a process driven investment. It's just that when I build a portfolio of individual stocks, for example, for a client, it's not just let's just buy Zoom. It's let's see how much we already have exposed to technology. Let's see where we could make room for it. Let's see how big or small the position should be in the portfolio. And let's see if maybe you have too much tech already. So maybe we eliminate another tech stock to buy Zoom. That's just as an example, okay? A process-driven investor, they're more into, I would say, automation. Process-driven investor is somebody with, let's say, dollar cost average, a certain dollar amount into an investment account every month. They don't necessarily have to be someone who just buys index funds. By the way, you cannot invest directly into a stock market index. You could invest into a security that tracks or mimics an index. But that's just a little nuance I have to share with you that I think it's important. But they're into automation. They're into reinvesting. They're into saying, I'm not going to worry about the stock market this year. I'm not going to say, well, one of my exchange traded funds and small cap was down last year, so it's not a good investment. I don't want to be in it anymore because this year small cap is doing very well. So it's part of accepting that just because an investment in your portfolio is not doing well now, it's not a matter of that being a bad investment. It's a matter of it's not time yet for that particular investment to do well. But process-driven investing means over time, all of your investments should do well over the long term. they'll just do well at different times in the short term and intermediate term. That's process driven. So a process driven client would be somebody who says, I'm going to add $5,000 a month to a particular account, and every month we're going to buy more or less the same securities in the same percentages, the same proportion, and I'm going to do that every month. I'm not going to worry about, oh, my account statement was down, the market went down. I'm not. It doesn't mean anything to me. I'm just going to keep doing this. I trust the process that in 15, 20 years or 30 years, I'm going to have a substantial amount of money from making these investments. And I don't care if it's $50 or $5,000 or $50,000 per month. It's the same exact concept. And that to me is the difference between, hey, I just want to make money in this or that and grab different investments that could make money, as opposed to investing with a purpose and saying, based on my risk tolerance, I should only be, maybe only 70 cents out of every dollar that I invest should actually be invested into stocks. 30 cents out of every dollar should be invested into bonds, for example. And maybe if you're younger, it might be 90% into stocks. Maybe if you're older, it might be 40% or 30% into stocks. So that's what I mean by there's got to be a process to investing. So when somebody calls me up and says, hey, I want to buy Pfizer, or I want to buy Moderna, or whatever other, hot stock is out there, I really don't want to call Pfizer such a hot stock, but let's say Moderna. You get the drift, though, right? I'm like, I got a call from somebody. I received a call. Oh, Apple split. We should buy it. Why? Well, because it's split. I know stocks that split go up, right? Stocks typically split because they go up a lot, which happens in bull markets, which is why stocks go up when they split, because we're in a bull market, not just because of a split. If stocks only split during bear markets, then I think it's fair to say that stock splits would be a bad thing, and you'd see them go down when they split. All right, just want to get that in there, because a lot of people think that having 5 $1 bills, 5 singles, is worth more than having a $5 bill. But it's just you're taking the same pie and slicing it up, but it's the same volume of pie. I'm in the mood for pizza. So having said that, that's the difference. And a process-driven investor focuses on how their investments fit into their overall financial plan. They'll focus on estate planning, making sure they have the correct beneficiaries on all of their retirement accounts. They'll make sure that they are employing strategies, legal strategies, to minimize taxes. Certainly speak with your tax advisor about that. I'm not a tax advisor, okay? But I know enough about taxes because, I have to know about this stuff to do my job, right? Okay. And they focus often on, will focus on insurance. So there's a lot more to it, and charities, things like that. There's a lot more to wealth accumulation than just trying to beat the clock with better returns. Over time, in my experience, and I think this could be corroborated by every study out there, investors who try to, let's say, game the system, and they're going for higher returns and investing more aggressively, they have really good runs, but they don't keep the money. They usually wind up giving it back, and they wind up doing worse than a long-term buy and hold investor, because the buy and hold investor didn't pay as much in taxes, transaction fees. And then when you start selling, how do you get back in? Do you decide, well, I'll wait till things go lower? I'll wait till the stock market goes lower. Then the stock market goes up, and you're like, no, I'm not going to buy now because I could have bought when the stock market was lower. And then the market goes lower again. And you say, well, wait a minute. You know what? I'm going to wait till the market goes lower. It just becomes endless procrastination. So results-driven investors believe that timing the market is the best way to go in accumulating wealth with your investments. Process-driven investors believe that time in the market is better at building wealth for them than timing the market. Okay, so let me repeat that. Time in the market is more important than timing the market when it comes to wealth accumulation. That is the key difference between a results-oriented investor and a process-driven investor. They both want good results, But the results oriented investor, results driven investors, they try to manipulate things by over trading, by chasing hot stocks to try to earn a higher, quicker return. Whereas the process driven investor trusts the process, invests regularly, typically on an automated basis, and has faith in the process that over time their investments will work out. So that's the difference. So when you say everybody wants to make money in the market, all investors want to make money, that's true. But there's a difference between results oriented and process oriented investors. And in my time in we've got a couple of comments out there. Let me just take a quick look because I want to see who's out there. Okay. Travis is out there. Hey, great convo, Mitchell. Thank you very much. And I love your videos too, by the way. You always put out some really good content. So follow Travis. And who else is out there? Nick. Hey, Nick. Thank you. Nick Lozano. Thank you, man. I really appreciate you driving. Why did I say? I really appreciate you showing up. And Travis says, yo. Happy holidays, by the way. So that's really cool, man. I really appreciate you guys being out there. It's really cool, man. Yeah. By the way, that reminds me, I do want to do a live stream on picking pot stocks, just random stuff to say. And my sister, when she edits this video into this live stream into little clips, she's probably going to be like, what were you thinking? Okay. So I really appreciate you sticking with me for this long. And thank you very much for joining me. And I will speak with you soon. And I hope this helps you out with your understanding of, results versus process driven. And I hope this helps you become a better investor. All right. I'll speak with you soon. I will be out tomorrow. Tomorrow's Wednesday. I'll be out. I'll be back Thursday.